Hello and welcome to the latest Wealth of Advice market update recorded on Wednesday the 7th of May. When I'm catching up with clients recently, again the dominating factor tends to be Trump and his tariffs being discussed. Thankfully, the volatility has reduced with the 90-day pause, and in this update we'll have a look at global market news and look at things like interest rates and Trump's volatility. So as I started there, the uncertainty surrounding the US trade tariffs certainly remains high, and it's likely to continue to feed market volatility. Throughout April, the implications of these trade policies were seen with the equity markets, the bond markets, and global currencies. So we saw a lot of volatility. The month started with President Trump tariffs being announced, and that caused the S&P 500 to fall by over 10% in 2 days. People who watch these videos regularly will be aware of the VIX index, and as you can see from this chart, it spiked to its highest level since the pandemic. And as people know, markets really don't like uncertainty, and that's what Trump had created with this short-term impact on the markets. It was uncertainty and fear, and that's what the VIX market there reflects. Gold was a big winner of April with the uncertainty, and this marked a new all-time high. Commodities shed some of their year-to-date gains as metals weakened and oil prices fell by 16% amid recession fears and a decision from OPEC members to boost supply. So again, when we're thinking about clients, we're having long-term reviews, Trump's volatility really affects the short term, but again, as we go through and look at the long-term performance, it's about staying invested in the markets, because as we saw when Trump had the pause, markets went up quite nicely, and like we saw with the index falling quite quickly over a couple of days, we actually saw one of the largest rises in the S&P 500 as a result of that pause. So, stocks recovered much of their losses after Trump announced that 90-day pause in tariffs, and it was the 9th of April when the S&P bounced back by over 9%, and that's the largest daily gain we've seen since the 2008 financial crisis. The FTSE 100 ended the month of April well and achieved its longest streak of positive days, which was at 16 days with positive returns. So I've had a couple of client reviews this week, and actually they've said, when I've looked at figures, I thought things would be much worse because of what's been said in the press and what's been presented in the news. So again, it's about that perspective of thinking about what actually impacts the investments, and with our clients with globally diversified portfolios, which are appropriate for their level of risk, actually we don't see quite as much volatility as is presented in the news. But overall, globally, people are rightly focused on things like the tariffs and how this will impact relations between the US and China and specific key manufacturing areas such as electronic products and the potential tariffs and taxes as things are moved around the world. In April, developed equities ended the markets up, and they were up 0.9%, with US markets underperforming most of their global peers. Again, this has come with pressure on Trump to try and fix things and resolve things quicker. And some analysis has said that Trump is actually trying to put pressure on the US Federal Reserve to cut interest rates, which will help support growth and reduce government debt costs. This is a dangerous game of chicken with the global economy at stake, and it could backfire as tariffs are inflationary, which could keep interest rates higher for longer. But actually, we're seeing the Bank of England are likely to cut interest rates this week, and actually we are seeing that with those potential fears of recession caused by Trump's volatility and uncertainty, it's more likely that central banks will cut interest rates. I've actually seen recently in an article that UK mortgage providers have dropped their interest rates, looking at the 2-year, 3-year and the 5-year rate. So again, that's in keeping with the analysis that we've seen in relation to that. So, how have asset classes performed in general in 2025? We often show this sort of patchwork quilt to show the need for diversification, because it's not always the same stock or the same element of a portfolio it's driving returns. As you can see at the bottom here, over the year so far up to April, commodities have fallen the most, and we've seen growth stocks have had a positive return, but actually going back previously, sometimes they're at the bottom of the chart, sometimes they're at the top of the chart, which is why we need to blend these global investments, these equities and bond holdings to try and produce those positive returns. So again, during times of market volatility, some clients say, well, why don't we just sell to cash and then buy back into the investments? And why aren't we doing that on a regular basis? Well, fund managers, the people who are making the decisions in relation to the underlying building blocks of the portfolios, they are making the decisions to change investments, and they are making the decisions to move between asset classes or companies or holdings within that area. But actually the idea of moving from being invested into cash means you potentially fall, you avoid those times when markets go up. This chart here is very interesting, and this is showing that why it's important to stay invested. And this shows that the best days from investment returns tend to come during most volatile times. Again, we've got this here where we can see the Great Depression when we go back to the 30s. We've got the global financial crisis from 2008. And then we've got this trade war here, which is appearing with that lighter blue bar. Again, we've got COVID, and we've got other events such as the 87 crash and some more of the 30s with the depression and recessions. So again, that shows that if someone had seen these times of volatility and said now's the right time to go into cash, actually they would have missed that rise from the S&P 500 of over 9% that we described earlier. Another reason to stay invested is because actually this is all part of a normal market cycle. We see volatility, market volatility isn't something new. And as you can see on these charts, these show how the calendar year finished with investment performance. This is looking at the FTSE All-Share, a UK investment, but then that red dot is how far the indices fell as a maximum in the year. So we've got some times when things fell by 37% or 43% or 36%, but ultimately the top bar there shows how the indices finished the year. And as you can see, more often than not, we've seen a positive return, even though we've seen a fall of 10%, 4%, 6%, 7% in the year. And this data helps reflect that. So people sometimes say this feels a bit different in the moment, but actually when we look at the data and present it here, actually it's to be expected that we have volatility, and as a result of the market volatility, that's where there's opportunity for investments returns, and we see that when we're invested for the long term. Moving away slightly from investments and thinking about houses, I already mentioned that the mortgage rates are softening slightly and coming down, and this analysis here shows that UK house prices have declined slightly in April. The data shows that they fell by 0.6% in April, and this was the steepest monthly fall in 20 months. The reason for this might be because of increased stamp duty, and people almost trying to squeeze property transactions before the rules change. Nationwide said house prices are still 3.4% higher on average than this time last year. And as I mentioned, some mortgage providers are seeing, with those interest rates coming down, they're offering better value for those mortgages as well. Early indications suggest that there was a significant jump in transactions in March as people were trying to bring forward purchases before the stamp duties increased. So again, this might just see less transactions happening as a result of people pulling things forward. When we look at UK manufacturing, again, there's been analysis to say that this has been shrinking slightly in recent months. UK factories were hit by the biggest fall in overseas orders in 5 years as a result of that global trade war from Trump. Again, people waiting to decide and see what happens with those tariffs between the US and major partners. When the S&P Global's Purchasing Manager Index is below 50, this shows that manufacturing is slowing, and as you can see from this chart, that's fallen to about 45%. The survey reveals the pressures mounting on factories from US tariffs, and again, this is one of the reasons why there's pressure on Trump to try and resolve the global tariffs quicker rather than later. And every day when I look at the press, there's some sort of leak news of the US talking to countries and trying to have the new norm agreed on what's going to happen going forward. The UK approach, we've seen that optimism has tumbled to the lowest point in almost 2.5 years. Again, this could lead to things like job cuts, And this could be in line with things that we've seen for the pandemic when cost pressures jumped. So again, we're looking to see how this will make an impact on investments going forward. But there's also, Trump can cause problems very quickly, but things can also be resolved very quickly with Trump and how he does his politics. If we use this opportunity to look at Trump's first 100 days in power, we've seen some analysis. And as you can see from this chart, there's the approval ratings of what's happened so far. When he returned to power in January, he was promising to reboot America, and he said, from this day forward, our country will flourish and we will be respected again all over the world. We will be the envy of every nation. Since his inauguration, he has moved at breakneck speed to execute a radical agenda, directing the world's richest man to gut the US government. Again, we've seen this in the news about the tariffs and about what Musk will do in relation to spending less in the US. So this has created, as we well know, volatility and has caused more uncertainty around the world. April ended with the news of a US-Ukraine natural resource deal, which granted the US access to investments in Ukraine's natural resources in return for continued military assistance. The deal was reached as Trump marked the first 100 days of his term, and he's under pressure to secure victories as polls have shown an erosion in his favourability, driven largely by the economic policies and the tariffs. He's also been frustrated in relation to not delivering on his promises to bring quick solutions to the likes of the Ukraine conflict and Gaza. So again, I wouldn't be surprised to see Trump trying to quickly change things and quickly trying to be more popular and resolve things. Trump seems to be a self-fulfilling prophecy in the sense of he really wants to be loved and he really wants to see market growth, but he is trying to do everything up front to try and crack those eggs and make those changes that he wants to try and improve things going forward. So as anything, we think about the long term, and we'll wait to see how these things play out over that period. When we move to look at the market performance and see how things have done, when we look at the usual charts since the start of 2025, we know it's been a volatile period. That light blue chart at the top there shows the European markets, shortly followed by the blue, which is the FTSE 100. And then the biggest faller in 2025 has been the S&P 500. That's the US index. And that has also pulled down the MSCI world that you can see there. Again, a lot of that volatility was caused, in April as a result of Trump's tariffs and the global bits that we need to see play out. But towards the right of the chart here, we have seen how the 90-day pause, caused more certainty and a relaxation where markets then sort of got back to a bit more normality. When we zoom out further and look at these indexes over 1 year, we saw how things had done well, from September and October all the way up to February and March. And then you can see very clearly the volatility that's been created in April. But even there, when we look at the FTSE 100 and actually the tick up from the MSCI World and the S&P 500, that has come back nicely from the low point. When we zoom back even further and think about the long term, which is of course 5 years plus, you can see that COVID's disappeared and we've now got more of a clear pathway of how investments have returned. The S&P 500 was the clear winner over the period, but as we know, it's seen more of the losses in the short term, which is why we have a more diversified approach when it comes to investments. As always, I hope you found these updates interesting, and if you have any specific questions, please get in touch. We're continuing to talk to fund managers and economists and to pull our research so that we can communicate with you in relation to what's happened with the markets and what we expect going forward.